thank you all so much for being here tonight. I hope you're enjoying the evening so far. This happens to be one of my favorite venues. The outdoor area where we have our cocktail area is just fabulous, so I hope you're enjoying the night so far. So again, thank my staff. We say we get to plan a party for 200 to 250 of our best friends every 6 months. And it is quite a bit of work, but they pull it off seamlessly. So I want to thank them this evening. You know, Mike introduced some new faces to the firm, and I want to take a few minutes because it speaks to our growth. And I want to mention that because I really want to thank everyone here in this room for that. Not just our clients, but our staff. And I think it comes from a number of reasons. As I look around tonight, I know there's people here that I've known for almost 30 years. There's many of you here that we've had relationships for 15 to 20 years. And so it's the long-term loyalty of our clientele that really helps us. And as I look around, there's a lot of new faces as well. And that has a lot to do with your willingness to introduce new relationships to the firm. And there's no higher compliment that you can pay us when you extend that invitation. And it means a lot, and it does not go unnoticed. So I want to thank you for that. And I hope it has a lot to do with something that we strive for every single day. And we strive for excellence in our customer service. And I think, you know, I look at a lot of company websites, and I think it's a tagline in a website or a byline in a company mission. For us, it's our culture. And it's about everything from the first voice you hear when you pick up the phone and call into 1015 Associates, to the time that you spend with your advisor going over your personal concerns, making sure that your questions are answered, to the securities that we spend the time and the dedication to select what goes in your portfolio. It is a culture that we live every day. And this room really, to me, speaks to that. So I want to say thank you. It's a privilege and an honor to work with you, my staff, and for you guys. So thank you very much. So with that, I put together a presentation that I hope you'll all enjoy tonight. And for those of you who are new, we have kind of a regular agenda that we like to follow. We're going to talk about where we've been, where we currently are, and then we'll wrap up this evening talking about the things that we will be focusing on as we go into the second half of this year. We like to start the evening with some trivia. And so in keeping with some of the headlines out there, we'll test your ability to determine the difference between two headlines. Which one is fake news and which one is real. So we'll just, for those of you who are new, it's just an opportunity to kind of get your minds going a little bit. You've had some time to visit and eat and spend some time with friends. So we'll get your mind going before we get into the real meat of the evening. So number one, Pluto has been officially reclassified as a planet. Or performing CPR, humming the Macarena could help. Guess what? It's the Macarena. It just so happens to be the song has about 103 beats per minute, which is the perfect rhythm for doing CPR. So if you ever unfortunately find yourself in the situation. So the next one, mushrooms might hold the secret to clean laundry. Or the Palestinians recognize Texas as part of Mexico. Well, those of you who are in charge of the family chores, maybe you want to chuck a few mushrooms in the washing machine next time. They're not only efficient, they're highly energy efficient and environmentally friendly. Politically correct students are campaigning to rename Imperial College and King's College London. Or female-named hurricanes probably do not kill more people than their male hurricanes. Well, guess what? The gender of the hurricane actually does not matter, but erroneously, there was a headline 3 years ago. A scientific study claimed that storms named Debbie, just by chance, are predisposed to kill more people than storms named Dawn. The study alleged that people don't take female-named storms as seriously. After numerous studies, they found this not to be true. I want to know who has the time to do this stuff. All right, one more. Lawmakers seem confused about what Facebook does and how to fix it. Or Charles Manson is to be released on parole to Johnson County, Texas. Yeah.
That's not going to happen.
This one was a dead giveaway when I said lawmakers seem confused. That should have been the giveaway. So,
Giveaway's a pun.
yeah. So, all right, terrific. Let's move on to the evening. So, how has this year gone so far? We opened up January. We were together the 3rd week in January of this year, and this market literally came out of the chute like a rocket. January, we had 14 new highs. It was a record number of new highs for the month of January. As we moved into the end of January, we unfortunately met February. February, that big deep dive that you see at the very beginning of the chart, during the month of February, the market went into correction. It is the first correction we've had in almost 2 years. By the way, to be defined a correction, it is a down move of at least 10%. Once we came out of that, the market has literally just kind of bumped along. We recovered. What has happened is volatility has increased significantly. That top inset chart, that's the past 18 months, that nice smooth upward line that we enjoyed last year, that's 2017. As soon as it starts to hit all the bumps, that's 2018. So we've certainly seen a lot more volatility. You can illustrate this in a number of ways. Again, first 2/3 of the graph, that's the weekly change of the S&P 500 for the 2017. As you get into 2018 and all of a sudden those lines start jumping, higher highs, lower lows, much more volatility. That's what's marked 2018. We can look at it in the number of days that the market has moved 1% in either direction. Last year was the anomaly. We only had 4 days in 2017 that the market had a move of 1% or more in either direction. I know I certainly didn't mind it. Now in 2018, we've already had 36 days with 1% or more move. That's the average for about the average for a year, and we're only halfway through the year so far. So what happened? We came into the first part of January, we got tax reform, there's all this pro-growth mantra that's going on out there, the market takes off, and all of a sudden the fears of inflation start to circulate, bond yields start to spike, making market participants pretty nervous. We started very early on with the trade talk. And so investors got spooked about the geopolitical risks, and we have a new Federal Reserve chairman who seems much more set on continuing to raise interest rates. So it just seemed we went up, and everything that I talked about, we knew all of those things in 2017. Nobody seemed to care, and by 2018 in January, everybody started to worry about all of those things. What it has caused, and typically what happens as the economy starts to unfold, investors begin to pick their winners and losers. This is representative of all the different sectors of the S&P 500 as of June 30th of this year. 2 top performing sectors for the year, technology and consumer discretionary. This should make sense. Consumers have more money. They are spending. Businesses still are willing to spend money for efficiencies, so you get the consumer discretionary and the technology. 10% performance. On the bottom of the heap, consumer staples and telecommunications. The staples get hurt by higher commodity costs. When there's fears of inflation and prices go up, those input costs rise, hurts the staple stocks. Investors own the staples. They're typically high dividend type stocks, as are telecommunication stocks. And when bond yields rise, you have another asset class that is competing for those dividend or yield hungry investment dollars. So on the bottom of the heap, we get your consumer staples and your telecom stocks. When you put it all together, the S&P 500 was up 1.7% as of halfway through the year. But it's been a tough environment out there, because if you look at the rest of the chart, although the S&P was positive, international markets were down, emerging markets were down, commodities were down, gold was down, and the only other area positive there are REITs. So it has obviously been a tough market, even if you're highly diversified for the first 6 months this year. One of the things driving the market are corporate earnings. And I love this statement. It said, tax reform was the fairy godmother of corporate earnings. When you cut the federal tax rate from 35 to 21, it means there's a lot more profit that can drop to the bottom line. And that's exactly what we've seen. Corporate profit growth has been exceptional. That's all the different sectors of the S&P 500. Top profit growth was in the oil sector. We talked about this last year. We've had a revision from $27 a barrel oil back up to $70 to $80 a barrel oil. That equates to strong earnings growth. But when you look across the averages there, somewhere in the middle, it tells you S&P 500 earnings up on average almost 25%. And a lot of people are assuming that that doesn't take a lot into account for the tax reform because we're early on in the year. So the expectations are we're going to continue to see strong earnings. What I think caught people really by surprise was the number of companies that beat the earnings estimates. And so again, there's all these, they have the estimates, then there's whisper numbers, and it's all about expectations. That green bar there tells you that's the percentage of companies within each sector that actually exceeded expectations, which is really phenomenal. It's 78% of the companies that reported earnings reported better than expected earnings. So why isn't the market up a lot more? On average, if you have a strong quarter of earnings, the market will rise about 1.1%. Stocks have risen 0.2%. So why are we not seeing much stronger stock performance? Well, I'm going to talk about the fact that the market is a forward pricing mechanism. It's trying to look forward to understand where things are going, not necessarily where they are right now. So this actually makes some sense, right? The market went up all of 2017 on hopes of higher growth, on hopes of tax reform, on hopes of strong earnings. And the market just kept climbing. And that's what we got. And so I'll tell you this, 1.7% after the strength of the year that we had last year, that's a victory. It means it justifies that what stocks did last year are now justified. And I talked to people all year last year, and they were worried that there was this big giant air pocket in front of us. The market kept on climbing, and everybody assumed it's just going to hit a pocket and we're going to drop. What we're seeing right now is justifying that we move. And it kind of makes sense that the market is consolidating those moves. Now the market is looking forward from here to try to figure out, what do you got for me now? And so that's why we see a little bit of a stall in the market right now. So what does that mean? Price to earnings ratios have fallen. We talked last year at the end of 2017 that the market was starting to look expensive. A PE ratio is one way that we can value stocks. Are they cheap or are they expensive relative to history? Well, if the E in the PE ratio goes up significantly, but the P remains flat, that means we've got declining ratios, which says that valuations look more attractive than they were last year. So that helps. There's another ratio that a lot of people are starting to follow, and we mentioned this last year, so I'll bring it up again. It's the CAPE. And the CAPE is a new version of the PE, which essentially takes into account inflation. So on an inflation-adjusted basis, the market still looks expensive. We're trading at really high levels on the CAPE. But a lot of people are trying to understand, is this as relevant as we think? And the assumption is that because we are now in a global economy, we've got extremely low interest rates, and corporate strength, corporate earnings are as strong as they are, that the CAPE may not be as relevant in this particular environment. Unfortunately, you know the fact, right? We won't know until afterwards whether these things were telling us something or not. But these are the types of things that analysts and economists are looking at when they're trying to evaluate where the market is. We have to talk about interest rates. We couldn't have a discussion about the stock market without understanding what's going on in the interest rate environment. That peak up there at the back end of the chart, during the early part of 2018, 10-year Treasury rates breached 3%. We traded over 3% for the first time since 2014. And that's one of the things that really started to make people nervous, because as soon as we got to 3, then the assumption is, oh my gosh, we're going to just continue to go right on up. And I want to bring your attention to 2 things on the chart. That deep dive, that V at the bottom, exactly 2 years ago right now. I remember being in front of you in July of 2016 and trying to understand why 10-year Treasury rates were sitting at 1.4%. It had a lot to do with the commodities meltdown that we were in the middle of. So do the math. We're sitting at about 280. In 2 years, 10-year Treasury rates have doubled. This year alone, they're up almost 20%. And if you look at the back part of that chart, what we can see is higher highs and higher lows. The trend definitely seems in place that interest rates are headed higher. So what are the things that are going to influence bond yields? And there's a lot of things that are going to move bond yields around. We have spent the last 7 or 8 years together talking about the Federal Reserve. The Federal Reserve, as it had to do with interest rates. There's a lot of other things, and this is one thing we haven't talked about. It's supply. And what do I mean by that? I mean that we need to finance our tax cuts. It's going to cost us $1.9 trillion over the next 10 years to finance the tax cuts. We're going to need another $1.3 trillion for the omnibus spending bill. And oh, by the way, the government deficit should be running about $1 trillion by 2020. And our US government debt will top $16.5 trillion by 2020. We finance that debt by issuing government bonds. Who's going to buy all these bonds? We have spent a lot of time over the last several years talking about demand. So this chart shows us the purchases of US Treasury bonds. That line dead center, that's the year 2007. So what I want to draw your eyes to is that big green line that rose dramatically. That's a rise in the purchase of US government bonds. That is from foreign governments. We talked a lot about the fact that during the financial crisis that we were, I guess you could call it the least ugly sister at the dance. And so money flooded to the United States because all governments were comfortable in investing their money here and buying US Treasuries. So we had this automatic demand. Our own Federal Reserve said we're going to step in, we got quantitative easing, we're going to buy bonds back. And I said to you at the time, when you have a buyer at the table every month, if I need to sell a widget, and every month I show up to sell my widgets and I know you're going to be there to buy them, it sets the price. That's exactly what was happening in the bond market. It set high prices and low yields because you always had the demand. Well, if demand is starting to dry up, the Federal Reserve is no longer buying bonds. We don't know what foreign purchases of US bonds are going to be in the future. If supply is rising and demand is declining, it could interrupt that nice smooth path that we've seen for interest rates. So let's do a little bit of simple math here. If our debt is at $16.5 trillion and we finance it at 5%, that's $825 billion per year just to service our debt. Tax receipts last year were $1.6 trillion. That means it would swallow 1/2 of all the tax receipts, which is more than what our defense budget is for 2018 and equivalent to what there was for Social Security. If our debt gets that big, it's going to impact the amount that the government has to spend on other programs, which affects your growth. So I guess these are some things that the stock market could be worrying about, even though corporate earnings are so strong. What about the emerging markets? Last year, we talked about the fact that as the statistics come back into norm, the developed markets had outperformed the emerging markets for a long period of time. Emerging markets were really starting to pick up. They're commodity-based economies, and that would probably be a good place to think about having some money. That hasn't worked out. Emerging markets are down quite substantially this year. But I think we need to understand that we have a longer-term perspective of international investing in this market. With the debt and the potential growth in the United States, Morgan Stanley put out some research that says Asia's total equity market capitalization could double over the next decade to $56 trillion, overtaking North America as the largest equity market region, accounting for more than half of the growth in the world equity capitalization. So when we look at where dollars will go over the next decade, a 6-month downturn in emerging markets, I would say that's a very short-term look at what is a much longer-term trend that we need to follow. What about Europe? It was also another bright spot of hope last year. The unemployment was declining, growth had returned, they were growing at about 2%. And Europe has failed to be a spot of good places to be this year. Their consumer spending is going down. They've got political unrest. They've got problems, obviously, with trade. So as we look to Europe, there is also weakness in Europe as far as where to invest in this particular market. So where does that bring us now? Growth is actually good across the world. Those dark gray areas represent the developed markets growth, which is running between 0 and 3%. The developed economies are supposed to grow at about 2.5% for 2018. The emerging markets are supposed to grow at almost 5%, for overall global growth at about 3.9%. That really speaks to that idea that we came into 2018 of a global economic recovery. What do we need to keep our eyes on? It's all about the geopolitical risks, right? This matrix that was done by Blackstone, and it looks a little bit complicated, but there's 2 things that I want to point out. So the vertical axis is the probability that any one of these events may happen. So the higher on the chart means it has a higher probability that it's going to become a problem. The horizontal axis represents the potential damage to the financial markets. So of course, way over there in the right corner, the one with the highest probability also has the likelihood of the most damage, which is US-China relations. And we are playing that out in real time every single day. Yesterday, 200 points down, all about trade talks with China. Today, for some reason, that was no problem. We're up 200 points today. So that is being played out every single day in the markets. In the middle there, and it might be hard to notice, but it's North American trade. This was less of a problem when this matrix was produced, but with the recent tariffs that we now have on aluminum and steel with Canada and Mexico, North American trade is now something that the market is also worrying about. And we sit and wait. America's trading partners are promising tariff retaliation that could affect as much as $43 billion of exports, everything from motorcycles to pork. Certainly something to be concerned about. And the problem with tariffs are, when you slap tariffs on aluminum and steel, it makes all those products more expensive in the United States. It will raise the cost of an automobile, raise the cost of a can of beer. And that potentially slows the economy and what? Costs jobs. And the math is really difficult. Jobs in the US industry that use steel or steel inputs outnumber those involved in the production of steel by 80 to 1. So there's certainly a reason that the market's concerned about this. The graph there of the United States, the deeper shades of red, this is showing concentration of jobs that would be affected in those industries. And you can see the whole East Coast, the whole eastern part of the United States, heavy concentration of some of these jobs. Let's break this down a little bit further and just show you how complex this problem has become. This is Boeing aircraft. Boeing happens to be a name that we own in some of our portfolios, so a name that some of you are familiar with. This demonstrates the need of US businesses like Boeing, as many other businesses across the United States, how dependent they have become on a global supply chain, meaning the free flow of goods not only around the United States, but across borders in order to produce and sell these planes. Everybody involved in trade, and you can see all the different pieces of that plane they're coming from Japan, China, Hong Kong, as well as here in the United States. Everybody who participates, trade is beneficial. The problem is, some have benefited more than others, particularly China. And the restrictions that the Chinese have on the US doing business in China that forces our jobs and our technology to joint venture firms in China, that needs to be fixed. And we do believe that ultimately these negotiations that we're going through will be resolved to the better of US businesses. But in the meantime, you can see that one airplane has a lot of pieces that need to come from a lot of different places, and any interruption in this business comes to a screeching halt. So China has another front, and this goes back to the bonds we were talking about. As of January, China held almost $1.2 trillion of US government securities, making it the second largest holder of debt, foreign holder of debt, only number 2 to our own Federal Reserve. For years, we've talked about the fear that China would start dumping bonds into the market. And if they were sellers of bonds, that it would disrupt the markets. And it would send interest rates much higher as they dump those bonds. We need right now for them to keep buying bonds. The amount of supply that we have coming, we also need China to continue to buy the bonds as they come available. Now remember this, China needs us more than we need them. This is a dangerous game that we're playing. But we do need to resolve some of these issues, and all of these things are going to be playing out in the media. They're highly emotional, and they have ramifications to everyone. So how are investors feeling about this? This chart happens to be the very last week of June, from the third week of June to the fourth week of June. And it shows the amount of bullishness dropped by 10 points, putting it below the long-term averages. The amount of bearishness increased by 14 points, putting it above the normal. Now, what we want to say and remember is this particular chart, which we've talked about before, often is a contrarian indicator, meaning at a point that investors really start to get nervous, it's probably a point at which stocks have some value. And we closed today, the S&P was only up 1.7 as of the end of June. Today is July 12th. S&P is up 5. NASDAQ hit a new record today. So when this was published, definitely a good contrarian indicator, at least if you look that short term. But investors are nervous out there, and you're going to feel that, and that speaks to the volatility that we're seeing right now. So where are we going? We're not going to the movies. And we'll take a little bit of a break from some of this heavy information and talk about something a little bit more fun. So movie sales actually for the year 2018 were down 5.8%. We're down to levels that go all the way back to 1992. So we're not going to the movies, we're just viewing movies differently. But I'm going to test your movie trivia quick, and then we'll get back to the presentation. So which of these movie characters said, "You're going to need a bigger boat"? Sheriff Brody and Jaws, do I get all those guesses out there? If you guess Jaws, any of you are big fans of the Jaw movies, absolutely you're correct. Which of these movie characters said, "Well, here's another nice mess you've gotten me into"? Sons of the Desert, absolutely. And this one I think is the real giveaway of the bunch. This is a classic in my house, must see every season. Do you see what's happening? Potter isn't selling, Potter's buying. And why? Because we're panicking, and he's not. George Bailey, It's a Wonderful Life. So, I'm going to come back to George in a little while. All right, so where are we going? We are right now, and most of the developed economies are, in the latter stages of an expansion. And the economy goes through normal cycles of recovery, expansion, and then contraction. And we know we're definitely somewhere in the later stages of that recovery. And when I talked about stocks looking forward, I'm going to ask you to go back with me so I can help you understand how to look forward. If that made any sense, let me walk you through this. Let's go back to March of 2009. I know that doesn't bring up good memories to me, so I don't really want to do that to you. But in March of 2009, this economy was in really bad shape. We were shedding thousands of jobs every month. Unemployment was around 6 or 7%. Stock market was in complete turmoil. The financial system as we know it had come to its knees, and people were wondering what the future would actually bring. And somehow, in March of 2009, this market turned up. It was looking forward, understanding that through the work of the Federal Reserve and the US government, that what they had provided in the form of stimulus would ultimately begin to fix the economy. And stocks traded right up all the way through 2009. It actually marks the beginning of the recovery that we're still in. Unemployment, by the way, did not peak until December of that year, 9 months later, at almost 10% unemployment. But March through December, the stock market just chugged higher. because investors were looking forward. So now, unfortunately, we're on the other side of that. We've got low unemployment. We're sitting around 3.8 or 4% unemployment, and unemployment will probably go down further. We're hoping for a GDP print as high as 4% in the second quarter. We're on the eve of earnings. We're expecting good earnings again this quarter. But the stock market is paying attention to what the Federal Reserve is doing. And the Federal Reserve is now putting on the brakes by raising interest rates to keep a lid on the growth. So the stock market's trying to figure out at what point will now the slowing efforts of the Federal Reserve begin to actually slow down the economy. See, we're in Goldilocks now, right? And I've said we've been here for a while. Economy's getting better, the stock market's going good, housing values have recovered, but we all know, we're realists, right? We're not going to be here forever. And we will see a contraction at some point in the future. And the tough part about this is that the market is usually smart enough to smell it first. And the market will turn down before the economy actually slows down. So we're somewhere in that transition period, but from the words of George Bailey, there's no need to panic. There will be bargains then too. So it's all part of a natural process. So what's going on? Inflation is going up. The Fed says we're a little bit light of his target, but inflation is creeping up. A little bit of inflation is not a bad thing. Inflation is good for a lot of different industries. Pricing power is a positive thing. And I think of it this way. We've spent the last decade fighting deflation. Well, if you don't want deflation, you want the opposite, right? So we've been fighting deflation, so I think we were trying to get some inflation. So all of a sudden we get a little hint of inflation and people go nuts. No, a little bit of inflation is good, but the problem is, at some point, it's not. And there's always that moderation of how much inflation is no longer good inflation. But we're worried about inflation moving up. The Fed is raising interest rates. Here's the probability. We're probably going to get another hike in September, and we're going to get yet another hike in December. And so I think of it this way. See, interest rates, we live in a debtor nation, right? We talked about all the government debt. The households in this country are in debt. For a lot of people, higher rates is a really bad thing. Well, I see in front of me a room full of savers. Higher interest rates are actually pretty good for savers. By a show of hands, is there anyone here who really liked 0% interest rates? No, I didn't think so. So a little bit higher is okay. And again, we just don't know at what point will it become a slowing impact to the economy and at what point it's good. But a little bit of a rise in interest rates is actually a healthy thing. Monetary policy around the world is tightening. Last year, we talked about the fact that 10-year Treasury rates in the United States did not go up. Even though the world was getting better, the stock market was going up, we're talking about a tax reform, and 10-year Treasury rates did not go up. One of the reasons that I cited to you was the fact that interest rates around the world were still negative. Those foreign economies were still providing stimulus. And again, when I talk about negative interest rates, I still don't know what that means. But we knew two things. They're not good, and they're unsustainable. So the fact that we're starting to see governments around the world begin to tighten monetary policy, that's normalization. That's actually good. So when there's worry, and we don't want it to go too far, because back in 2006, everybody was tightening, and money got too tight, and the economy came down. So we are tightening, but I see it as a positive. So how are the economists feeling about this? How are strategists feeling about this? You've got a lot of moving parts. We've got a lot of growth out there. But according to some of the economists, the global economy continues to grow at a healthy rate. although the buoyant mood of the last quarter of 2017 has become more tempered. 2018 will be characterized by tightening monetary policy and credit conditions, increasing risk to global trade, and deeper political concerns of the Middle East. Real GDP has trended lower over the last 50 years, primarily by slowing labor force growth and productivity. Positive cyclical momentum caused growth to pick up in the second half of 2017, and optimism is high that 2018 will do well. Yet the gravitational pull of structural headwinds is powerful, and over the long term, investors will need to expect lower returns for longer. I've heard about lower returns for longer for the last 7 or 8 years, so I guess maybe that's a concern. According to Ben Bernanke, the Trump administration tax cuts make the Fed's job more difficult, providing stimulus at exactly the wrong time, that we're already at full employment. It's going to hit the economy in a big way this year and next year, and in 2020, Wile E. Coyote is going to go off a cliff and look down. That's from the father of 0% interest rates. And maybe a little bit on a lighter note, diversification is key. When money just goes irrationally into stocks without some fundamental review, we think there is a risk. There is a place for both active and passive investment, but a risk-adjusted portfolio is really important. My investment advice is to have a diversified investment portfolio and not put all your eggs in one basket. Certainly the philosophy that 1015 Associates lives by. There's not a golden arrow. There's not one thing that can solve for all the problems that we have and all the objectives that we have in our portfolio. It takes a lot of different things, and they become different over time. Different things solve different problems. So let's sum this up. The economy is still healthy. Even in the most recent employment report, there was a little bit for everyone. We produced another 200,000 jobs this last month. The unemployment rate ticked up a little bit, but that's because people were optimistic enough to actually come back into the workforce, and they're finding jobs. Labor, the wages are rising. We haven't seen wages in this country go up in a decade. We're finally starting to see some wage growth. That's a good thing. GDP, the forecasts are for a 4% print. Hopefully we get actually an over a 3% year this year. That's a positive. We are on the eve of earnings tonight. The big banks will begin to report earnings tomorrow morning. It'll definitely set the tone for the earnings season. It just so happens to be Friday the 13th, but just saying. The headwinds are mounting. We've got inflation, but it's not that high. We've got a Federal Reserve who said he's willing to let the economy run a little bit hot, meaning he's willing to let the inflation come through a little bit and let this economy actually pick up. He doesn't want to stomp his foot on the brakes too fast. So a little bit of inflation is okay. We talked about rising interest rates. We're still so low, there's room for rates to rise before it's damaging to this economy. Geopolitical risks and trade. The market is telling us, and we believe, that the trade disputes that are going on right now will be resolved positively. It will likely take an awful lot of volatility in this market before we get there, but the momentum of this economy right now should be able to bear the brunt of the psychological issues that we're going through. There's an awful lot that can go wrong, but you wouldn't see a market, and think of it very simply this way. We came up in January and we've been flatlining here, right? It doesn't take the market 6 months to make up its mind that it's a high. The market is consolidating, it's digesting some of these issues, but the market could very easily have gone down an awful lot with some of the things that we're dealing with. It's telling us that there is a possibility, a strong possibility, that we get a positive resolve to some of these things. We're in the later stage of a recovery. And again, I like to put it in terms if you're in a baseball game. We're definitely not in the first couple of innings any longer. We're maybe even past the 7th inning stretch, but we do believe that there are several innings left in this game. We are now in what is the second longest recovery in history. So I'm going to leave you with a question tonight. I'll leave you on this note. Why can't it be the longest recovery? In my book, records were made to be broken. So, on that note, I'll leave you for the evening. Safe getting home. Enjoy the rest of your summer, and thank you very much for coming.